Share capital is the financial architecture of every company. The Companies Act 2013, from sections 43 to 72, builds a complete framework, euros, what kind of shares you can issue, how you issue them, what rights they carry, and what happens when you need to change the capital structure. Section 43 defines two kinds of share capital euro: equity shares and preference shares. Equity shares carry voting rights and a residual claim on profits and assets. Preference shares carry a preferential right to dividend and to repayment of capital in winding up euros, but typically no voting rights. Equity shares with voting rights are the default, but Section 43 also allows equity shares with differential voting rights, euro DVR shares. These can carry higher or lower voting rights, or dividend rights that vary. The 2019 amendment made DVR shares easier to issue, letting startups give founders control while raising capital. Preference shares come in several flavors. Cumulative euro, unpaid dividends accumulate and must be paid before any equity dividend. Non-cumulative euro, if no dividend is declared, the right is lost. Participating euro, the holder gets a share of surplus profits beyond the fixed dividend. Redeemable euro, the company can buy them back. Convertible euro, they can convert to equity. Section 55 is the master provision for preference shares. It mandates that no company can issue irredeemable preference shares. Every preference share must be redeemable within 20 years. Infrastructure companies can extend this to 30 years with prescribed conditions. The redemption clock is ticking from day one. Section 53 contains an absolute prohibition euro. No company can issue shares at a discount. A share of face value 10 rupees cannot be issued for 9 rupees. This is a cardinal rule of capital maintenance. The only exception is sweat equity shares issued to employees under prescribed conditions. Section 62 governs the rights issue. When a company issues shares, it must first offer them to existing shareholders in proportion to their holding. This is the preemptive right euros. It protects shareholders from dilution. The offer must remain open for at least 15 days and not more than 30 days. Shareholders can renounce their rights in favor of another person. This creates a market for rights euro. The rights entitlement can be sold on the stock exchange if the company is listed. The rights issue is not just a protection. It is a financial instrument in itself. Bonus shares under Section 63 are issued out of free reserves or the securities premium account. No cash comes into the company. The shareholder's percentage holding does not change euros, but the number of shares increases and the price per share adjusts. Bonus shares are a signal of financial strength. Sweat equity shares under Section 54 are issued to employees and directors at a discount or for consideration other than cash euros for their know-how, intellectual property, or value addition. SEBI regulates sweat equity for listed companies. The quantum cannot exceed 15% of paid-up capital in a year or 25% for startups under 5 years old. Buyback of shares under Section 68 allows a company to purchase its own shares, but it is heavily regulated. The buyback must be authorized by the articles, approved by a special resolution, and the debt-to-equity ratio after buyback must not exceed 2:1. The company cannot issue fresh shares for 6 months after a buyback. Reduction of share capital under Section 66 requires NCLT approval. The company must pass a special resolution, and the tribunal must be satisfied that creditors' interests are protected. Reduction can take many forms euro: extinguishing unpaid capital, paying off paid-up capital, or cancelling lost capital. Every form requires the tribunal's sanction. The prospectus. Sections 26 to 32 govern the document through which a public company invites the public to subscribe. It must contain all material information the company's business, financials, management risks, and the purpose of the issue. A misleading prospectus attracts civil and criminal liability. A private company cannot issue a prospectus. It can only raise capital through private placement under Section 42. The offer must be made to a limited number of identified persons euros, not more than 200 in a financial year, excluding qualified institutional buyers. The offer letter must state that it is a private placement. Let me give you a concrete example. A tech startup valued at 50 crore wants to raise 10 crore from a venture capital fund. It issues Series A preference shares, if euro convertible, with a liquidation preference and anti-dilution protection. The shares are issued through a private placement. No prospectus needed. No public offering. Just a term sheet, a shareholders agreement, and a board resolution. Voting rights are not uniform. Section 47 says every equity shareholder has a right to vote on every resolution. But preference shareholders can vote only on matters directly affecting their rights euro, like winding up or capital reduction. However, if preference dividend is unpaid for 2 years, preference shareholders get voting rights on all matters. Dividends are declared out of profits under Section 123. The board recommends shareholders approve. Dividend must be paid within 30 days of declaration. Unpaid dividends must be transferred to a special bank account within 7 days and to the Investor Education and Protection Fund after 7 years. Dividend is not automatic euro. The board must recommend it each year. The securities premium account under Section 52. When shares are issued at a premium RR above face value R, the premium goes into a separate account. This account can only be used for specific purposes: issuing bonus shares, writing off preliminary expenses, writing off share issue expenses, or providing for the premium on redemption of preference shares. It is not general company funds. Alteration of share capital under Section 61. The company can increase its authorized capital, consolidate shares, subdivide shares, or cancel unissued shares euros, all by an ordinary resolution, unless the articles require a special resolution. Increasing authorized capital is one of the most common shareholder resolutions in growing companies. Let me address a common confusion. Authorized capital is the ceiling. Issued capital is what the company has actually allotted to shareholders. Paid-up capital is what shareholders have actually paid. A company can have authorized capital of 1 crore, issued capital of 50 lakh, and called-up capital of 25 lakh euro with the balance uncalled. These distinctions matter for compliance, for fundraising, and for liability. The key takeaway: share capital is not just accounting. It defines control euro who votes. It defines distribution euro who gets paid. It defines dilution euro who loses percentage. It defines fundraising euro how you can bring in money. Every section from 43 to 72 is part of a single integrated framework. Understand the framework and you understand how companies are built, funded, and governed. Whether you are an entrepreneur issuing your first shares, an investor evaluating a term sheet, or a director approving a rights issue euros, the share capital rules affect your decisions. Know the framework. Use it strategically. Thank you for watching.